Good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, June the 19th, 2025. Let's immediately see what's going on. Of course, we do have the Juneteenth holiday in the US. So the futures markets are closing early today at about sort of 1 o'clock or 2 o'clock, depending. So it's probably going to be a fairly quiet day, but let's nonetheless have a review and see what's going on. Okay, so yesterday we had the Federal Reserve. Not a huge amount of surprises if we actually just look at and see the market reaction, just in terms of some of the main indices here. Let's have a look here. We can see that the stocks basically yesterday, this is a daily chart, didn't do too much. They only moved, 5 or 10 basis points. Have come off a little bit this morning, but I think that's a geopolitical thing. And if we look over at the bonds in the US, let's look at something like, I don't know, the 2-year. You can see that yesterday it went up a little bit and then is essentially fairly flat on the day. So not a huge amount of energy. One thing which has gone up a little bit is the dollar. But again, as you can see here on the dailies, not a huge amount of energy. And just talking about the dollar, you can see here that it's just hovering here around the 20-day moving average, but probably more importantly, this sort of downtrend line here, which is finding it a bit difficult to break. But what did the Fed actually do? It was fairly I think I have to say expected. First of all, they didn't cut rates, but no one expected that. What they did do, which is interesting in terms of maintaining their dot, they maintained the 3.9% which is essentially 2 cuts for 2025. So initially the market rallied because the market thought that this was sort of a dovish, this is quite dovish. The Fed is saying, hey, we're still going to cut twice. But what you can see here is that if we go out to 26 and 2027, it was actually raised 3.4 to 3.6, 3.1 to 3.4. So essentially they took out a cut from 2026 and 2027. And of course, nobody knows what's going to happen in 2026 and 27. And in fact, Powell him said in the press conference, he downplayed the dots and said, hey, it's our best guess, essentially. But still symbolically, what they were basically saying is that they think the neutral rate maybe is going to be a little bit sort of higher going into the future, especially 2026, 2027. And that's reflected really about inflation concerns. And that was probably the biggest change, but again, relatively expected. If you look at the core PCE, we went from 2.8 for the end of 25 from the March projection up to 3.1. So essentially here, pushing up the inflation expectations for the core PCE, which is their preferred gauge, by 0.3. And then if you look here, the unemployment rate also going up, and the change in real GDP going down, so from 1.7 to 1.4. This is for 2025. So essentially what we have here is the Fed, which is concerned about inflation, raising their core PC, and basically saying that the economy is going to slow down. So it's almost like a stagflationary environment, which is not as good. And you say, well, why aren't they going to cut? And Powell in his press conference, which of course I listened to, was essentially saying again and again that the overall trend of the sort of inflation seemed to be coming slowly down towards their objective, their goal of 2%. But there are two main issues, which is really in a short term is sort of, although that's probably not the main thing, is what's happening in the Middle East and the potential for energy prices to spike. But the main thing is that Powell repeated again and again and again that they just don't know what's going to happen in terms of the flow-through effects of any potential inflation sort of resulting from the Trump tariffs. And essentially what Powell said, he said that, yes, we haven't seen much inflation yet, but the new inventories and what they're hearing from companies will probably be reflected in higher prices to consumers. And in fact, what he did say yesterday, he said very clearly that at some point in the food chain, so to speak, someone has to pay the tariffs, either the producer, the importer, the company having less profit margins, or the consumer. And Powell said he didn't exactly know how that was going to shake out, but in one shape or form, prices would probably go up. And therefore, he essentially said that they would need another 2 or 3 or 4 months to really understand the effects, potential effects on inflation going up or maybe staying stable from the tariffs. So absent the tariffs, I think we'd have to say that we probably would be getting sort of rate cuts, probably now or in the next meeting or two. So they did keep these penciled in, but definitely the tone was a little bit pessimistic. Well, it's cautious. The Fed is basically saying, we're in no rush. The economy is good. The unemployment situation or the labor situation is strong. So they have the luxury, according to Powell of waiting. So, and it actually, if you look at it here, it was actually quite, so they did maintain their two cuts for this year, but this is very close because if you actually look up here, we have one, two, three, we have 7 members of the committee who actually is saying no cuts. So you see here, this is where we are at the moment. You see on the right here, the effective Fed funds rate between 425 and 450. Basically, we have 7 members of the FOMC committee saying they don't believe any cuts at all. Now, of course, we have a couple more doves down here. So I wonder where Powell is here. It's possible that he's actually in the no cut camp, but there are still at this point, the median is for 2 cuts, but it's not to say that, 5 people are basically, and actually, 7 and actually another 2. So 9 committee members are basically saying just 1 cut or less. So this is it's pretty tight. This could very easily could have been, one cut taken out of the median dots. Okay, so again, the market had essentially priced that, and if we just look here, just going back to the on the Bloomberg terminal, let's just look at the WIP function, world's interest rates, and what we can see here is that essentially, if where we're priced now for the end of the year is 1.85 cuts, so it's under 2 cuts. But if we go back, and as I've been showing you guys over the last, sort of several days, you can see here that this is 50 basis points cuts by December, which is the 2. And as you can see, depending on the data, sort of hawkish data, so strong data, then a softer CPI and PPI, and then now we had the Fed meeting yesterday. Initially, with the 2 cuts still being priced in the market, sort of went down to about 45 basis points of cuts, but subsequent to that has come down again. So essentially, we're around about 50 basis points of cuts, and it's going to be very simple. The market will need to see evidence that there's no inflation. So let's say we have another month or 2 or 3 of low inflation prints, and maybe there's some kind of sort of deal with the tariffs, and the tariffs actually end up being, 2, 3, 4, 5% rather than 10, 20, 30%. That would give the Fed more confidence to cut. Or secondly, we would have to see a significant and, well, just a very significant and obvious deterioration in the labor market. Now, Powell himself yesterday seemed to sort of indicate that he believed that the labor market was slowly deteriorating, but not enough to cause concern. So the only thing I think which would really get the Fed's attention at this point would be a very significant sort of fall off in the labor market. Maybe down to 50,000 jobs, negative jobs, print, or possibly the unemployment rate, going above 4.5, 4.6, 4.7, something like that. Initial claims maybe over 300,000. We would have to see something very, very strong. But at the moment, we don't have that. And as you can see, as Powell's press conference here, this is the intraday, so the tick chart, short term. So you can see that as Powell started speaking, you see here that the market did start to price out less and less cuts. And you see here now this morning, we're at 46 basis points. So it's about 1.85 cuts. So that's where we are with the Fed. So I think at this point, in theory, the Fed doesn't want to do anything probably for another 2 or 3 months if they can. And Powell, he said very explicitly yesterday that he's ignoring Trump. He doesn't care what Trump calls him. He's not going to be under any pressure there. So I think the best case scenario is that probably what's going to happen, the market will probably be reluctant to price out, any cuts this year. So I think that for December, for example, this number here, we're probably going to oscillate, range between 1 cut and 2 cuts, which is probably the equivalent of 25 basis points up to 50 basis points of cuts, in general, depending on inflation readings and the real economy. Now, of course, that could change if there's anything significant happens. But I think for the next month or 2, unless there are major surprises, that's where we're going to be. Now, we also had the Bank of England just this morning at about 7 o'clock, so just about half an hour ago or so. They held. So let's just look at the pound here. Do I have this here? USD. I'll put it on the spot. So we have JGB USD. So we can see here the pound's been very strong against the US dollar, like a lot of currencies over the last 2 or 3 months here. But it actually has come up against a little bit of topside resistance, quite a key level here, about 136.50 or so. So just taking a pause and it's come off. But what we can see here is that the pound is still very strong in terms of the moving averages. You see here all the EMAs. And this is a very bullish chart still, all lower, sort of higher lows, higher highs. We now are starting to get a little bit of sideways consolidation yet. But to be honest, this is still not problematic from a sort of a technical point of view. And if we actually just look at, let's say, this latest impulse and put a Fibonacci on it, we can see that, we haven't even breached the 50% Fibonacci from this latest impulse here. So this could just be sort of a pullback and a pause. And who knows if we get a bit more upward strength. In terms of the meeting this morning, as I said, they held. The Governor Bailey of the BOE, he basically said that it's possible that inflation will continue to sort of moderate a little bit, and that the gradual path was downwards. So it looks as though the BOE is looking to do maybe not cuts every meeting, but maybe once per quarter. So we could have a cut at the next meeting, which I believe is in August. In terms of the Monetary Policy Committee, so they have 9 people on that committee. 6, so a majority were in favor of a hold and doing nothing, but 3 people wanted to actually cut. So there are a few doves on the BOE. But at this point, I think that the pound is a function mainly of the US and risk, because being an open economy, the pound generally likes a reasonably good sort of global trade situation. So at this point, this chart is still looking quite strong, but you'd have to be concerned. Probably the key areas are going to be below this when it starts hitting this 50-day EMA here, which would coincide with this fib. So I think at this point, the bulls are still in control. It might be interesting to see if we get a daily close above 133.25, something around about this level here. That would signal that some of the momentum is coming off, and this is turning into something more than just a simple sort of sideways consolidation and retrace down. We shall see. The other interest rate decision, which we had earlier this morning about 3 o'clock, 3:30, I think it actually was the Swiss National Bank. Kind of interesting. The Swiss National Bank, they did cut by 25 basis points. So they're now down to 0. And there's always the chance here that the Swiss National Bank could actually go negative. And in fact, the governor said at the press conference this morning that, also in the statement, that negative interest rates were a possibility. It's not their preferred mode. But one of the problems here is that inflation, they actually revised their inflation forecast downwards. And so there's still concern, the Swiss National Bank, about inflation becoming deflation and actually pushing down the prices too much. And that's also a function of the very strong Swiss franc. You can see here, for example, USD versus the CHF, the Swiss franc. You see here the US dollar has just lost a lot of strength over the last sort of 6 months or so, and it's actually down about 12% against the Swiss franc. So very significant devaluation of the or loss in value of the US dollar versus the Swiss franc. And the Swiss national authorities, or the national bank, they're worried about that, because with about 23% of the GDP in Switzerland is actually imports. About 20, I was reading this morning, about 21, 22, 23% of imports makes up the GDP. So therefore, we have a very strong Swiss franc like we're seeing it at the moment. Basically that is deflationary, which you could argue is a good thing, but once it becomes deflationary, that becomes a problem. And so the Swiss National Bank at this point, they probably want to see a slightly stronger Swiss franc. They don't like it to be historically below the 80 level here, and you see here we're getting pretty close to the 80 level against the US dollar. And that's actually the level in 2015 where they intervened. So they'll be happy to see this US dollar getting a little stronger. We'll see if this still has sort of a strength. But at this point, the Swiss this morning also said that they wouldn't, they still could intervene directly in the currency markets, which have done a lot in the past. But they are a little bit worried at the moment about being labeled a currency manipulated by the US Treasury. So maybe that's not their preferred action. So that's going to be an interesting one to watch. But you'd have to say that if this goes a little bit weaker in terms of the US dollar here and the Swiss franc strengthens, it wouldn't surprise me to see some direct intervention by the Swiss National Bank. And who knows, they might even sort of cut interest rates into negative going forward if if the inflation readings continue to be deflationary. Finally, guys, what I want to look at is just to look at the oil market. Let's grab some tea here. Now we know at this point, there's still as we speak here about 7:40 in the morning, there still hasn't been, and just double check, there still hasn't been any attack by the US on the nuclear facilities in Iran. but Trump is threatening that. I personally think, although who cares what I think, I personally think Trump would prefer a negotiated settlement. There are a lot of members of Trump's sort of party, the Republicans, his faction, the MAGA faction, who really do not like foreign adventures. They do not like intervention in these wars in the Middle East. And Trump himself is on record, a lot historically over the last 10, 15 years, saying that the US should not be involved in these wars. Having said that, this is maybe he sees it as a reasonable opportunity to sort of put back Iran's aims to develop a nuclear bomb by 5 or 10 or 20 years. So it's possible that he will go through this sort of option and use that huge bunker bomb. But I think he probably doesn't want to do it. But nonetheless, we can't pretend that we know what's going on. So the oil market is still pretty nervous, is the point I'm trying to make, because there's still a lot of sort of thoughts that maybe something could happen in any time, like today, tomorrow, over the weekend, who knows? And we could wake up with a big spike. And also the other thing which is getting the oil market a little bit nervous is that a former minister in Iran was out yesterday basically saying that it would be a great idea to shut the Strait of Hormuz for about 100 days, just to put pressure back on the rest of the world. And keep in mind that, as I've said many times, and as we all know, the Strait of Hormuz, about 20% of the world's oil actually flows through there daily, about 20, I think it's 21 million barrels, not only from Iran, but also from a bit from Iraq, but Saudi Arabia, United Arab Emirates, et cetera, all coming through there. So that would cause oil to spike massively if that were to happen. So therefore, the risk premium is not going away. We can see here on the call, put sort of skew here. You see here the calls in the you see the calls in the white and the puts in the orange here. But more importantly, is probably you see that overall is going up. So volatility, oil volatility on an outright basis is going up a lot. You see, just like 10 days ago, down at 35, it's basically doubled, or almost up at 70 now. So that's gone up a lot. But also, if you look at the put call ratio, you can see here that the calls upside protection is it spiked initially, but it went down. But now it's maintaining this elevated level. So there was some hope of maybe a de-escalation a few days ago, but essentially that's no longer the case. If we look at the curve, this is the live reading. So you see here very much still in a backwardated state. Obviously, this is from a week ago in the blue. So you can see that at the front of the curve, still a call for that. And then also what's interesting is to look at the which a lot of institutions trade and big traders, is the December contract. So we've got December 25, December 26. And you can see here on a 60-minute chart that over the last 7 days, that's basically ramped up from basically 50-cent premium all the way up to $3.26. So we're at pretty high levels now. And I think that's actually, if we go back, we put out, let's say on a daily going back a few years, I think this is the highest level. Yeah, it's the highest. It's getting towards, some of these pretty high levels where it hasn't been. So we're getting up there to, quite sort of serious levels there. Now, this obviously could, if the situation escalates, obviously this could go higher. But of course, there's always the possibility of a de-escalation. And so just looking here at the front contract, you can see here that continues to push higher and higher. Still haven't made those highs, which we got, I think, over the weekend on Sunday here, up at $78. But still, the oil market, after thinking that there was going to be some de-escalation, is still maintaining that risk premium. Now, if the Straits of Hormuz and there is to be the attack, for sure, this could spike up a lot more, even maybe up into the 80s. But the idea here is that any sign of a de-escalation, and who knows, maybe even if the Americans and the Israelis do destroy that sort of nuclear facility, after a few days when the tension goes, and it's clear that Iran doesn't have the military capability to strike back, there could be sort of a bit of a de-escalation, and we could see oil just come back more into the 70 to 60 kind of range back down here. That's something I'll be looking out for. Okay, guys, as I say, we do have the semi-holiday in the US today. Let's just keep a look and see what's going to go on just the next few hours in terms of the futures markets. We see here that the equities have come off a little bit. And that could also be probably there's a geopolitical sort of stress here a little bit. You see equities sort of coming down. But it also could be the fact that the Fed's a summary of economic projections did forecast a stagflationary environment, so higher inflation and lower economic growth, which all things considered is not a great sort of recipe or cocktail for the equity market. We also see over in Europe, you see that the European equity is coming off. So global equity under a little bit of pressure this morning just because of, I would say, the geopolitics happening in the Middle East as well. And let's see if the bonds get a bid. But as you can see, the US bonds, don't really care and actually coming down, if anything. And the European bonds will go across to the Bund. Had a bit of a spike up yesterday, but not really spiking up. So the market, the only market which is really overly focused, well, very focused on the Middle East is the energy market at the moment. Okay, guys, I'll leave it there. Have a great day, and let's keep the conversation going. Thank you.